If you're renewing your mortgage in 2026, this update is for you. In this video, I'm going to help you understand what's actually happening with mortgage rates in Canada right now, why the rate your bank offers you may not be the best solution for your situation, and what you should be thinking about before you sign that renewal letter. This is especially important if you took a fixed rate between 2021 and 2024. And oh my God, if you tend to just auto renew with your bank, please watch the full video. And lastly, if you're not closely tracking your monthly household cash flow, this mortgage renewal season is really important for you. These are the people I'm making the video for, because this is going to be an expensive mistake in 2026 if you do this wrong. My name is Ron Caroni. I'm a mortgage broker based in Martensville, Saskatchewan. I'm licensed to do mortgages in both Alberta and Saskatchewan, and I spend a lot of my time helping clients understand their financing options with a strong focus on paying your mortgage off and making sure that you are comfortable in the home that you live in. Let's begin. What's actually changing heading into 2026? At a high level, it's not so much what's happening right now, but what happened 5 years ago with ultra low interest rates. The Bank of Canada is no longer cutting rates aggressively the way it did last year, and unless something very unexpected happens, we're likely moving into a more stable rate environment. Fixed rates have settled into a fairly predictable range, keeping in mind they're driven by the bond market, not the Bank of Canada directly. But the real issue for many people renewing in 2026 is that they took on a mortgage when rates were extremely low, often in a rising housing market, and now they're renewing into a world where rates are higher, and in some cases, home values have not increased the way people expected. That combination makes renewal decisions far more important than they were 5 years ago, especially from a cash flow and long-term comfort perspective. There are three groups of people who absolutely should not be sleepwalking into their 2026 renewal. The first group is anyone who had an ultra low rate but is already feeling a monthly cash flow crunch. Groceries, utilities, childcare, and insurance have all gone up, and if your mortgage payment is about to jump on top of that, you need to be planning ahead. In some cases, that means looking at restructuring the mortgage so payments stay manageable and you're not constantly under financial stress. The second group is people renewing directly through their bank. In most cases, banks do not automatically offer their best pricing to existing clients. You usually only get competitive pricing if you push for it. And even then, the offer may be limited in flexibility. This is where having a mortgage professional, or I should say mortgage broker, in your corner, it matters so much. You can see what's actually available in the broader market before you commit. The third group is anyone planning a renovation or investment but do not have cash sitting in the bank. Using credit cards or unsecured lines of credit for large expenses is often very expensive, and it can be a massive mistake, especially when there may be a more efficient way to access home equity, but only if you plan ahead of your renewal. Before we talk about actual numbers and where rates are sitting right now as of today, it's important to understand that not all mortgage rates are created equal. For simplicity, I'm going to break this down into two buckets: high ratio mortgages and uninsured mortgages. High ratio mortgages are default insured. These are typically mortgages that were originally set up with less than 20% down. Because the lender's risk is reduced through insurance, these mortgages usually qualify for the lowest rates in the market. Uninsurable mortgages are everything else. This includes larger properties, longer amortizations, and in most cases, refinances. These mortgages carry more risk for the lender, which is why the rates are generally higher. For a lot of people renewing in 2026, especially those dealing with cash flow pressure, the ability to extend amortization or access equity can be more important than chasing the absolute lowest rate. For high ratio mortgages, the best 3-year fixed rates are hovering just under 4%, roughly around 3.99%. 5-year fixed rates tend to land closer to the low to mid 4% range, around 2.4 to 4.4%, depending on the lender, the size of the mortgage. Uninsured rates are higher. On the fixed rate side, both 3 and 5-year fixed term generally fall into the mid 4%, with 3-year terms often slightly lower than their 5-year term counterparts. On the variable rate side, the most competitive variable insured rate are sitting around that mid to high 3s, while uninsured variable rates are typically in the low 4s, roughly around that 4.05 to 4.25% range. These rates will move as the Bank of Canada adjusts their policy rate, so they're not static. The key thing to remember is that lender promotions, mortgage size, and borrower strength all influence pricing. The rate you see advertised may not be the rate that you actually qualify for. Now, this is where a lot of people get burned. Mortgage rate is just one important part of your lender decision. You also need to understand how the mortgage behaves when life happens. How is the penalty calculated if you need to break the mortgage early? Is it close to a 3-month interest penalty, or are you exposed to a large posted rate interest rate differential penalty, which is still very common with big banks? Are there special clauses attached to that ultra low rate? Many no-frills products include bona fide sales clauses, limited prepayment options, or restrictions that prevent refinancing. In many cases, saving a few basis points today is not worth the future financial risk of being locked into a restrictive mortgage. If a rate looks unusually low, the first question should always be, what am I giving up to get this? The big takeaway from this video is that your mortgage should be treated as a core part of your financial health, not just a line item that you renew every 5 years. That means getting your options early, understanding your specific household situation, and choosing a mortgage that works not just today, but over the next several years. If you are cash flow strapped, your priority should absolutely be about reducing financial stress, not chasing the lowest advertised rate. If you don't have special needs coming up, make sure your bank is actually offering you a competitive deal, not just hoping you're going to sign the renewal letter without asking any questions. And if you are planning to access equity for renovations or investments, do that planning ahead of time, not at the last minute, because using high interest debt unnecessarily can cost you tens of thousands of dollars over time. If you're renewing in 2026 and want to understand where you actually land, I am happy to walk you through your numbers and options with you. No pressure, just clarity. If you found this video helpful, please consider subscribing. I'll continue to break down mortgage rates and strategy as things evolve. If you loved this video, you're gonna love this one as well.